Assalamu alaikum friends, welcome to question number 31 of SBR revision kit from your Kaplan. This is a question on section B which is for 25 marks. I was anyway going to do this question but a little later because I didn't finish my section A questions yet. The reason I'm doing this is because the student wanted this. He was having some doubt and he was waiting for my explanation for this question, so that's the reason I'm immediately uploading this. Okay. And this is also our latest paper because it is from December 2018, this question, worth 25 marks. Okay. Both question number 3 and 4 from section B are worth 25 marks. And question 3 and question 4, you can be asked current issues, conceptual frameworks, and all this type of questions can come in 3 and 4. That means your section B. So let's start. You have, you can see that for requirement A, you have 2 requirements and it is for 7 marks, and then we have B, we have for 8 marks, and we have C which is for 10 marks. So what's new for the section B is that you don't have a long case study that you used to have for section A. Section B is you will be having small paragraphs, and then you'll be on that paragraph you'll be asked a requirement, which is easier also, I feel, right? For example, you know that this paragraph is for A, this paragraph is for B. So let us start by A, and it's not related. A is not related to B, B is not related, it's not related to each other. You can answer in any order. Unlike in section A, it's better to follow the order because section A is group accounting and section B you'll be asked ethical accounting issues and ethical questions. Okay, so let us read. The main requirement says advise the directors of Phil on how the above transactions should be dealt in its financial statements with reference to relevant IFRS standards and conceptual framework. So this also question number 3, it is about the relevant IFRS standards and conceptual framework. Okay, this could be question 3 or 4. So section A, let us first finish section A. Phil is a coal mining company. He is a coal mining company and sells its coal on the spot in the future market. On the spot market, the commodity is traded for immediate delivery, and on the forward, the commodity is traded for future delivery. The inventory is divided into different grades of coal. One of the categories included in inventories at 30th November 2006 is coal with. So the one which is included with inventories. Which standard is it? IS2. Okay, it's always good to know the standards as soon as you come across a word so that it helps you later to, you can visualize the rule. You know that inventories are measured at lower of cost or net realizable value. This thing comes up as soon as you write the name of the standard next to it. So included in inventories at 30th November 2006 is coal. Okay, and a low carbon content which is of a coal with a low carbon content which is of low quality. So they are including this as a inventory. There are 2 grades of coal. Out of it, one is included as a inventory which is of a lower quality. Phil will not process this low quality coal until all the other coal has been extracted from the mine. You see, they will not extract this. This will be at the end after they've extracted all the coals from the mine, which is likely to be in 3 years time. This is likely to be in 3 years time. Based on the market information, Phil has calculated that the 3-year focus price of the coal will be 20% lower than the current spot price. Okay, calculate the 3 years focus price of the coal will be 20% lower than the current spot price. That means current spot price is low and the 3-year focus price will be higher. Okay, 20% higher than the current spot price. Directors of Phil would like advice on 2 matters. So here clearly they didn't say 7 marks how it is divided. So you can say 3 for conceptual framework, 4 for the second part, or 4 for the first one and the 3 for the, we'll see the marking scheme. But because if you are dividing 7 equally, it will be 3.5, 3.5, which is not wise enough. Don't take in points, take as a whole number. So it could be, let's say, 3 marks for this or 4 marks, or vice versa, 4 for this or 3 marks for this. Anyway you want to set, we'll see the marking scheme anyway to better understand this. First thing, whether the conceptual framework affects the valuation of inventory. It's very important that the marks you divide between these two requirements. Why? Because according to that, you will know how many points you have to write. If it's for 3 marks, you have to write 3 points. This is the reason you need to know exact marks, okay? Whether the conceptual framework affects the valuation of inventories. You should have a knowledge of conceptual framework. First lecture started with conceptual framework. Why conceptual framework can affect the valuation of inventory? What is inventory? First of all, it's an asset. It's an asset. So asset definition, recognition, everything is included in conceptual framework. So now using that knowledge, you can talk about it. Next, how to calculate the net realizable value of the coal inventory, including the low quality coal. There are two grades, one is high, one is low. How to calculate the net realizable value? Okay, so it's better to go in order. For example, this one, it's better to answer first, then this one. Okay. Now can we go to the answer before I go to the second one, because the second one is not needed. Okay, that is also about the same case study, but it is relating to a different thing. Okay, it is the company's fill only for all the three requirements, but it is relating to something else. For example, if you see the requirements in part B, the directors of field require advice on how to treat the reconditioning cost and whether the decline in the price of the coal is an impairment indicator. So this is about the reconditioning and impairment. If you don't read B also, it's fine. If you want to read all the three A, B, and C and then answer, that's also fine. But I think it's a waste of time. Okay, because separately marks are there for each. So first, how do you answer this? If you see part A and C, both of them require reference to conceptual framework. Yes, it's true. Conceptual framework can come in more than one question, one part. When I gave SBR, I remember I gave in, I think, 2019 I gave in March. My question number 4 was full conceptual framework. I think I got more than 2 or 3 parts it was about conceptual framework, right? So conceptual framework, please don't underestimate it. It's very important. Okay, don't underestimate the power of conceptual framework, especially in question 3 or 4 conceptual framework. You will get one question at least in conceptual framework. That much I can guarantee you. The rest is all up to you. Okay, because this is a key topic in SBR. It is heavily tested, heavily. And it's also chapter 1. My lecture 1 is on conceptual framework. You can go through that lecture. So when you're answering this, always make sure that you write a proper subheading. It's important that you write a subheading. So for first one is conceptual framework. Okay. When they're talking about inventories, okay, more than the asset part, it is more about the measurement basis. Because they told how IS2 should be valued. That means they're talking about the measurement basis. So you have to talk about under conceptual framework, what are the measurement basis. So conceptual framework acknowledges two measurement basis. Why we are talking about measurement basis? Because the requirement asked you how to measure inventory. Or if you want to go again, let's go again. How it affects the valuation of inventory. You see, valuation of inventories. It's true, inventory is an asset, but this is not about recognition of an asset or something. Question asked valuation of inventory. If the question asked, okay, whether inventory should be recognized or not, then you can use that form definition of an asset and then you can go through this. Question didn't ask recognition. Question asked valuation. Valuation means measurement basis. That means according to conceptual framework, how can you measure? So conceptual framework gives you two measurement bases. One is historical cost, the other one is current value. If you are very thorough in your conceptual framework, you'll be very quick to write this answer. You will not find any difficulty in writing this answer. But most of the students will be struggling here if you're not, conceptual frameworks knowledge is not so good. Okay, I mean they know it, they have learned it somewhere, but when they come to answer it, it's very difficult because conceptual framework has so many aspects. Which one to answer? It's very clear, you just need to see the word in the requirement. Valuation. So valuation means measurement basis. Okay, you have to link like this. So two, historical and current. Okay, now because this is, they told valuation of inventory. Inventories, how do you measure? Lower of cost and net realizable value. So you have to talk about net realizable value. NRV you have to talk. Cost we know, it is historical cost, lower of cost on net realizable. But net realizable value, what is it? That you need to define. So net realizable value is the current value measurement, right? It is the current value. It is the second one. But however, the conceptual framework is not an accounting standard. Is it an accounting standard? No, it's not an accounting standard. In order to determine net realizable value, the debtors would need to refer to IS to inventory. Remember, guys, whenever there is a specific standard on that, for example, inventory, valuation of inventory, they asked, right? There's a specific standard on that, IS2. So when a standard is there, conceptual conceptual framework, you cannot use that as a measurement basis for inventory because a specific standard is there. Conceptual framework you can only use when you don't have a standard. Here you have a standard for inventory, IS2, so you have to use the rule of IS2 to measure, because always the specific standards, uh, it rules out it overrides the conceptual framework. Okay, so you have to go by IS2 first. Priority should be given to IS2, then conceptual framework. Okay, so in order to determine net realizable value, you should use IS2, okay, rather than conceptual framework. So this much is enough. Easily you will get three. I would say this is 3, looking at the answer now, and 4. How this should be measured now. Okay, you see. So if you would try to answer this first thinking that conceptual framework is hard, I will answer later, you will be struggling here in the net realizable value. That's why I always say follow the order. It is very safe to follow the order, because based on your this answer, this is built. You see, you told here that net realizable value will be calculated or measured using IS2. So now you are using the rule of IS2 in net realizable value. Okay, IS2 defines. Now you have to tell according to IS2 what is the definition of net realizable value. Okay, it is the estimated selling price. This is as it is from the textbook. Okay, estimated selling price is the ordinary cost of business less the cost of completion and the cost of sale. That means from your sell price you deduct the cost of sale. That is your net realizable value in simple terms. Okay, so in this case, that means you are always bringing back to the case. In this case, the net realizable value will be determined on the basis of conditions which existed at the date of the statement of financial position, at what condition it was. So net realizable value will be based upon the most reliable estimate of the amounts which will be realized for the coal. The year-end spot rate will provide good evidence of the year-end spot price will provide good evidence of the realizable value of the inventories. Okay, did you see that? And where the company has an executory contract to sell coal at a future date. What is executory contract? To sell coal at a future date. Then the use of the forward contract price may be appropriate. Before you proceed, you have to understand this. What is this executory contract and why are they talking about the forward contract price and all? When it is appropriate. You need to go again to the requirement and see what is it. It is a mining company. Okay, let me highlight it. And its sales is sold on the spot and future market. Okay, on the spot market, the commodity, this is a commodity, the coal. What does it mean? Coal is a non-financial asset and you are using a contract to sell it. You are going in a future contract or a forward contract or future contract to sell it, right? To know that, you have to know the rule of IFRS 9, executory contract. It is there under IFRS 9. Okay, and executory contracts are not dealt under IFRS 9. It's not within the scope of IFRS 9 to deal with executory contract. Okay, Executory contract is like when you are selling like this, selling gold, you are selling a commodity. It's not a financial asset, it's a non-financial asset. Like in this example, if you say it's a coal, you are selling coal using a contract. That is known as executory contract. But to know more details, please you have to go through my IFRS 9 videos under embedded derivatives and derivatives, that lecture. It will be there. So this is like a contract you are having. Okay. Derivative you are using. The derivative is the forward that you are using. So if it is like that, okay, then you have to use the forward contract price. This will be more appropriate when if you are using the contract to use that price, because it's a fixed price. You will be selling at that price only in the future. Okay. However, if the contract is not executory but it is a financial instrument, it is non-executory but it is a financial instrument, what happens? In this case, this is not a financial instrument, it's a commodity, the coal, like a normal commodity. It is not a financial instrument. If it was a financial instrument, a non-executory contract, okay, under IFRS 9 or an NRS contract, because they have told contract to sell coal. That's why we are talking about contract from different aspect. One is from the financial instrument, the other one is from IS 37 NRS contract. Okay, because it's not clear which type of contract it is, so you need to bring this out in your answer. Okay, whenever the word contract is there, this things comes up. If the contract is non-executive but it is a financial instrument under IFRS 9 or an onerous contract recognized as a provision, onerous contract you always recognize as a provision. We recognize it, right? That's why they told recognize as a provision under IS 37. Okay, then it is unlikely to be used to calculate and net realizable value. Then you cannot use it to calculate net realizable value. Unlikely to be used to calculate net realizable value. Okay, that's the reason why you're talking about IFRS 9 and IS 37, because you cannot use it if it is under IFRS 9 or IS 37 as an honoris contract. Then you cannot calculate net realizable value. Now, what's the next one? So finally, you are giving a conclusion. The last paragraph is, it's like a conclusion you are giving. What should be the net realizable value? So Phil should calculate the net realizable value of the low carbon coal, referring to this, okay? Using what? See, they didn't say what is the net realizable value. No figures are given to there. So don't try to get numbers. The question is how they can calculate. You are just giving them the ways by using the forecast market price. Whatever is the market price, the forecast, based upon when the inventory is expected to be processed and realized. Okay. Future changes in the forecast market price, because you know that in the future forecast price might change, right? Or the processing and the sale of the low carbon coal may result in adjustments to net realizable value. Remember, net realizable value you have to do adjustments, because in the future focus market price might change, or even the processing and the sale of the low carbon coal may need some adjustments. Okay, so as these adjustments are, what are these adjustments known as? I know it's a bit tricky because it's jumping from one standard to the next, but my dear students, there is no way you have to. This is the trick of SBR, right? As these adjustments, remember, whenever there are adjustments, it's more like it is an IS 8. Okay, as these adjustments are what? They are changes in estimates. Aren't you changing estimates if condition changes, right? So it is dealt under which standard? IS 8. IS 8 deals with three things. One is change in policy, one is changes in estimate, the other one is error. But this is, you have to identify what is this when you're making adjustments to the net realizable value. It is not an error, it is not a policy, it is you are changing an estimate, because net realizable value also you are using based on some estimates. So when you're doing some adjustments to that estimates, that is known as change in accounting estimates, which is dealt under IS 8. Okay, so this will apply. IS 8 you have to apply finally. Okay, IS 8 will apply. With the result that such gain and losses will be recognized Gain and losses will be recognized in the statement of profit or loss in the period in which they arise. Why are we talking about net gain and losses? Whenever you make some adjustments, okay, to the estimates, there will be some gain or losses. Okay, so that gain or losses, where should you recognize? Profit and loss. Because sometimes some goes in OCI also, so don't get confused with other comprehensive income. Okay, it is profit and loss only. If that gain and losses is due to changes in estimates, like in this condition, when you are changing your net realizable value, adjusting it. So I hope till the first till here, okay, from the beginning till here, you now got the pattern of the answer, and now you will be able to write in future this type of questions if you get. It's a little bit tricky. You need little practice, and also you need to think. So you have to use your brains. Let your brain think for answers like this. Okay. Because reading is not the option. Anyone can go through the answer, read answers, and then they think that okay, they have understood the concept. It's not like that. It does not happen like that until you sit and feel that pressure, feel that tension. Okay, my time is going. What should I write? How should I write? How should I start? What should be my middle part? How should I end it? They have started with something, then they talked about IFRS and IS 37. Finally, they ended in IS 8 with profit and loss. How did they come to there? So for that, you need to adopt a good plan to write your answers. Coming to part B, we have to read the part B. Okay. At 30th November 2006, directors of field estimate that the piece of mining equipment needs to be reconditioned every 2 years. Okay, mining equipment, it's a non-current asset. You have to recondition it. So they estimated that this cost will amount to 2 million. It's just an estimation. That means in the future they have to do this. And 1 million for the labor cost. This is for the part and this is for the labor cost of their own employees. The directors are proposing to create a provision for the next reconditioning, which is due in 2 years' time in 2008. This is in 2006. Next year will be 2008, 2 years' time. Okay. So you can understand that they are talking about IS 37 because the word provision is there, along with essential and maintenance cost. There is no legal obligation to maintain the mining equipment. No legal obligation. These are very important words when you have to apply IS 37. To maintain it. There is no obligation that you have to maintain. That means you don't have to recondition it. No legal obligation. As explained above, it is expected that there will be future reductions in the selling price of coal. Selling price of coal will reduce in the future, which will affect the forward contract also being signed over the next 2 years by Phil. The directors of the field require advice on how to trade, reconditioning costs, and whether the decline in the price of the coal is an impairment indicator. Remember, there are some independent indicators that your asset is impaired. What are they? Some are known as internal factors, some are known as external. Internal is something within your control, within your organization. External is something it's not in your control. For example, exchange rate changes, interest rate changes is not something that you control. It's in the market. So they are external factor. So decline in the price of the coal is not something that you can have a control over. You don't decide on it. So it's a market. So this is an external factor. Now your thing is whether it's a factor and whether it is a sign that your asset has declined or not. The value of the asset. So here you have to use one is IS 37, the other one is IS 36 impairment for 8 marks. So since it's 8 marks, we can divide equally. 4 marks for reconditioning cost, 4 marks for impairment indicator. Because declining in the price is also a sign of impairment only. So first we are going to talk about the replacement cost. Okay, that means provision. You first need to identify what it is. Before you discuss provision also, you have to decide that it falls under what category. This one, the mining equipment. What type of asset it is? Is it an intangible asset, tangible asset? What is it? Okay, financial assets. So all these things you need to first clarify. A it is a tangible asset. It falls under IS 16. Okay, so IS 16 requires an entity to recognize in the carrying amount of PP when you're calculating it the cost of replacing part of such an item. What is the cost of replacing the part? When each major inspection is performed, its cost is recognized in the carrying amount of the item of the PP as a replacement if the recognition criteria are satisfied. Okay. So if you recognize that cost as a PP, what should you do? If the recognition criteria, of course, you have to satisfy some recognition criteria to recognize it as an IS 16. So this cost of replacing, it's like you're capitalizing it in the cost of PPE. Okay. So when it is recognized, you'll be recognizing this cost of replacing it in the carrying amount of the PPE. Any remaining carrying amount of the cost of the previous inspection is derecognized. Okay, because if you have to do it every 2 years. So let's say in 2006, you will be doing it in 2008. In 2006, it will be derecognized. It will keep changing the cost. That's why the cost of previous inspection, you derecognize it. The cost of performing a major reconditioning are capitalized. You see, major recondition, that means you have to make some major changes to the asset to make it so that it can be used and you can improve the asset. Those costs you can capitalize it. Okay, you definitely have to go through IS 16 to understand this better. The rules are there, what cost you can capitalize, what you just have to take as expense. So major reconditioning also is such a cost that you can capitalize it if it gives access to future economic benefits. Such costs will include labor and material cost. Together it is 3 million, one for labor, two for material of performing the reconditioning. Okay. However, costs which do not relate to the replacement of component. Remember, not every cost is because of the replacement of component or the installation of new assets, such as routine maintenance costs, should be expensed. Okay, routine maintenance costs are expensed. But if you are replacing a component or you are installing a new asset, you can capitalize those. Now let us go to the provision. But you need to first write this replacement cost part. Okay, replacement cost comes under IS 16, whether you can capitalize it, whether you expense it, or partially you capitalize and partially expense, you have to write it in this paragraph. That's what it is written here, IS 16. Now we are talking about provision. You immediately don't start talking about provision. Okay, so now let's talk about provision. It is not acceptable to provide the cost of reconditioning equipment as there is no legal. You cannot provide a provision for this. Not acceptable because there is no legal or even constructive obligation to undertake this reconditioning. Clearly, very clearly in the case studies told, they have told no legal obligation. Because to recognize a provision, you have to have a legal obligation that you will be undertaking reconditioning. If it's not there, no provision. As set out above, the cost of the reconditioning should be identified as set out above. You see, you need to write like this when you want to use something from the above. You are not repeating every time or writing the same things again and again and wasting time. So as set out above, the cost of the reconditioning should be identified as a separate component of the mine asset at initial recognition. You are capitalizing it. So if you are capitalizing it as a part of an asset, what should you do? You should depreciate also over a period of 2 years. This will result in the same amount of expense being incurred, being recognized as the proposal to create a provision. Expense will be same if you are recognizing a provision also, because provision also you'll be recognizing over 2 years. Now here, instead of provision, you are recognizing depreciation as an expense over the 2 years. So in terms of expense, it will be same over 2 years. The thing is, it should not be provision, it should be capitalized and then you have to depreciate. That's the difference. Okay. Next, we are talking about the impairment. This is a bit easier. Okay, so such standards always comes. Okay, it could come in your group accounting, it could come in your conceptual framework, it could come as a current issue, it can come under anywhere, or accounting issue, ethical issue. So you have to be prepared for it, especially standards like IS 37, which is provision, then impairment, IS 16, IS 38, which is your intangible asset. This type of standards always comes, so you have to be prepared for this. Okay, impairment, which is IS 36, says at the end of each reporting period, An entity is required to assess whether there's an indication that the asset may be impaired. Every year you have to see whether there are conditions to prove that your asset is impairing or not. The value of the asset is going down or not. Right? IS 36 says you to do it. So if you see that there are some indicators of impairment, you have to impair it. Right? IS 36 has a list of, you have to refer to this list of external and internal indicators of impairment. If there is an indication that an asset may be impaired, then what should you do? Calculate the assets recoverable amount. This must be calculated. Okay. So now your job is, because you have told list of external and internal indicators, you have to say this reduction in selling price, is it an internal or external factor? If it is a factor, then what should you do? How should you calculate the assets recoverable amount? All those things you have to write in this paragraph. So past and future reductions in selling prices may indicate that the future economic benefits which relate to the asset have been reduced, isn't it? Now you will not get that much benefit as you used to get before if your selling price reduces. Mining assets should be tested for impairment. So because of this, mining assets should be tested for impairment whenever indicators of impairment exist. Impairments are recognized if a mine is carrying amount. When are you recognizing impairment? This line don't forget to write. Whether it is any asset, you have to write this. If impairment you're talking about, impairments are recognized when the mine's carrying amount exists is recoverable amount. Okay, so however the nature of the mining asset is that they often have a long useful life. Next, you have to talk about the nature of that asset. Here, this is a mining asset. So you have to think. Not everything is given to you in the case study as it is. For example, the life of the mining asset is not given to you. Just things you need to think. Okay, it's easy. Mining, we know that mining is often a long asset which is there for long life. So long useful life is there, right? It's there for long term. It's not that today you're going to have the mining asset, tomorrow you're going to sell, or in 3 years. No, it usually has a long useful life normally. That's the nature of the mining asset. So commodity prices can be volatile. That means it keeps changing. But downward price movements are most significant if they are likely to persist for longer periods. See, if the price goes, let's say, just for 1 or 2 years, the price went down and then it went up again and it's following that trend only, then you cannot say there is an impairment. But if the prices moved very down and it never increases and it's for long period, the prices are going down only, then you can say it's an impairment. Okay. So downward price movements are most significant then, and also if it's for the longer period, not just 1 year or 2 year. If it's like, let's say, for 4 years, 5 years, the prices are down. In this case, there's an evidence of decline in the forward prices, isn't it? In this case, means this they are linking to the scenario. This is how you link to the scenario. Just write 3 words in this case, in this scenario. Okay, there is an evidence. You have to evidence of decline in forward prices. They told. So if the decline in prices is for significant proportion of the remaining expected life of the mine, that means if the mine is for 50 years and if the out of 50 years, let's say 40 years or 45 years, the prices are declining, then it's an impairment because they told significant proportion of the remaining expected life of the mine. This is more likely to be an impairment indicator. So when you're talking about declining price, don't just decide on the face of it that if the price declines an indicator. You have to talk about these things. What is the nature of the mine? It's long term. So if the declining price is for long term and for significant proportion of the useful life of the mine, it's more likely to be an impairment indicator. So it appears that the forward contract prices for 2 years out of the 3 years of the mining's remaining life indicate a reduction in selling price. Out of the 2 years, the prices are reducing. Okay. So this indicates a reduction in sales. So based on the market information, Phil has also calculated that the 3-year focus price. This was given in part A. You see that they told that the 3-year focus price of the coal will be 20% lower than the current spot price in part A of the question. This is why it's better to do part A first and then B then C. Even though it's not okay, but I always believe it to be that way. But even if it's not there, then it's okay. Even if you're not doing A also, because this is from the question, so anyway you should be able to write these points even because you're not using the answer of the party. This is in the case study now A, because it's the same company only. A, B, and C. It's just the issues are different. Okay. Before I go to this, I just want to check that para again where they told about the years. Okay. So every 2 years. Okay. Just yes, I want to find out that 3 years. Okay, yes. From here in 3 years time. Okay, so you know that this is the time of the period for the mine. Okay, all the coal will be extracted from the mine in 3 years time. So we know that, and you are calculating this reconditioning or this reduction in price in 2 years time. So 2 out of 3. Okay, this is how you get it. 2 out of 3. Okay, make sure that you know this proportion and from how we got it. So 2 years out of the 3 years of the mine's remaining life indicate reduction in selling price. Okay, next, now we are finally going the last paragraph. It's like a conclusion we are giving. So the short term market fluctuations may not be impairment indicators. If prices are expected to return to higher levels, if the prices goes down again, it comes up, it's not a sign of impairment. However, despite the difficulty in making such assessments, it would appear that the mining assets should be tested for impairment. How do you conclude it? By saying that in this condition it's difficult, right? Isn't it difficult to make assessment? Because they didn't say anything whether the price will later rise or not. They just told it's going to decline. So based on that, it appears that mining assets should be tested for impairment. So you finish it like that. You don't have to calculate impairment, figures are not given to you. You just have to write that impairment should be calculated or it should be tested for impairment. Anything is fine. Now coming to part C, very important because it is the major marks are for in this part, which is 10 marks. So it's hard to decide also how are you going to divide the marks because one requirement only. So Phil jointly controls the coal mines with other entities. The Theta mine was purchased by the three participants during the year. Phil owns 40%, other two participants own 35 and 25% of the mine. The operating agreement requires any major decisions to be approved by parties representing 72% of the interest in the mine. Okay, if you add 35 and 25, it's 60%, and he owns 40. They want 72 to make major decisions. The directors of the Phil which advise on whether the directors of the field which advise on whether the conceptual framework, again it is asked, will affect the decision as to whether field controls the mine. So this is about the controlling of an asset of a mine. Okay. Next, the directors are also wondering whether there are two requirements. You can say 5 for this, 5 for this. The directors are also wondering whether the acquisition of the 40% interest would be considered a business combination under IFRS standard. So many standards are asked here. One is IFRS 11, joint control. The other one is IFRS 10 to define control. One is conceptual framework, the first one, and the other one is IFRS 3, which is the last one here, the business combination. So many standards in this. So let us go through C. We start by saying the control. And to define this, we are using two things. One is conceptual framework, the other one is IFRS 10. One is the standard, specific standard for control, to define control, to say an entity has a control over another entity or not. Other one, we are using the conceptual framework. First is conceptual framework. We are using it. I mean, not using, but we are writing. So from both, you have to talk. Okay. So this is, you have to talk about what control. What does conceptual framework says about control? Conceptual framework states that an entity controls an economic resource if it has the present ability to direct the use of the economic resource and obtain the economic benefits which will flow from it. Two things. One is the ability to direct. The other one is economic benefit. They should get the benefit out of it by controlling it. For example, cash flow or anything. The other one is ability to direct. See, please understand the difference. It's not always that they will actually use their power, but they have the power. They have that ability that they can have a say, that they will tell that okay, this is how I'm going to use it. This is the way I'm going to use it. They will have that ability, but it's not compulsory that they are using that ability always. Okay, so even if they are not using it, still, if they have the power, still it is considered as control only because the ability is there. Okay. And also economic benefits. So these two things are there. You control with this is according to conceptual framework. Okay, an entity has the ability to direct the use of an economic resource if it has the right to deploy the economic resource in its activity. So this is there further building up about that ability to direct. They are explaining this further. Next, although the control of an economic resource actually arises from what legal rights, it can also arise if an entity has the present ability to prevent all other parties from directing the use of it and obtaining the benefits from the economic resource. What does it mean? That means control means you can stop other parties from benefit to obtain the benefit as well as to direct the use. That means they cannot have a say over it. You are the one who is going to have the influence. You are going to have the say over it. If you say use it like this, they have to use it like that. They cannot use it according to their wish. You are preventing them. We are preventing the other parties. That means you are having the control. And also they cannot have the benefit. You are stopping them from having benefit as well as the say over how to use it. Okay. So for an entity to control a resource, the economic benefits from the resource must flow to the entity instead of another party. That benefit should go to you, not to another party, by having the control of that resource. Okay, so now, although the conceptual framework gives some guidance on the definition of the control, existing IFRS should be used when making the assessment. What should you use, please? This is very important, not only in this condition, any condition you take, always preference should be given to the standard, IFRS or IAS standard over conceptual framework. Which standard is that which defines control? IFRS 10. What does IFRS 10 says? They state, immediately start saying, okay, what does the standard says on control? They state that an investor controls an investee. These terms are important. Investor controls investee. And you can memorize these things if you are learning IFRS 10 because IFRS 10 is not so big enough. Mostly if a question is asked on IFRS 10, it is mostly on this part. If a theory question is asked about the control part, whether investor has a control over the investee or not. So I think you can memorize these answers. When it is exposed or has right to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. You see the words power, expose, rise to variable returns. All these words are important in your answer. Should be there. Phil does not have control over the mind because because his voting power is not sufficient. So at the end, you have to say whether Phil has a control or not. So in this case, he doesn't have a control over the mind. Why? Don't just say he doesn't have the control. You have to say why he does not have the control. Because his voting power is not sufficient for it. See here. Again, we'll go through the requirements. Okay. Just he should have 72%. To make any major decision, 72% of the interest has to be there, but he's only holding 40%. And the other two, 35 and 25. If you add 35 and 25 also, 60% only. Okay, and if you are taking this 40 with 25%, still they will not have control. If you add this 40 with 35%, then you can have, then it will be 75%. But then you have to join with this 35%, the one who has 35% shares. You alone, you don't have a control with that 40%. Okay. So Phil does not have a control over the mind because his voting power is not sufficient for it to pass the operating decisions. You cannot make operating decisions based on the voting power they have. That will affect the mind's relevant activities and thus is written. is not sufficient for it to pass the operating decision that will affect the mind's relevant activities and thus its returns. You cannot have a say over the activity, nor you can have effect, nor you can affect the returns. You cannot change the returns they are getting. So no control. Now, next we are moving towards the next standard, IFRS 11. IFRS 11 deals with joint arrangements. You have to say in IFRS 11 whether it's a joint operation or a joint venture. If it's a joint operation, okay, use IFRS 11. If it is joint venture, you have to use IAS 28. So, however, in accordance with IFRS 11, you see, first they started with conceptual framework, then they moved to IFRS 10. Now, finally, they are moving towards IFRS 11. They told that they don't have a control. Okay, so definitely they will have a joint control. We'll see whether they have a joint control or not. Next thing is whether they have a joint control or not. In accordance with IFRS 11, it would seem that the joint control exists. Yes, you see, even though individually he is not controlling Phil, but joint control he has. More than one party is controlling. That is the meaning of joint control, right? But when you're writing it, you cannot write that in that way. That more than one party controls, that's why joint control exists. No. This is because two of the parties. Who are those two of the parties? Phil and the participant who owns 35%. Because Phil is owning 40%, the other party is 35. So 40 plus 35, 75%. More than 72%, you can affect. You can have a say over the operating decisions. They share the control. So Phil and the participant that owns 35% share control. So they share the control and operating decision require them to unanimously agree. You have to write this word, unanimously agree. Together they have to agree with it to make any operating decisions, not one person. And this unanimously agree, this word has to be there when it is joint arrangements to show that they have a joint control. So the mind does not appear to be a separate entity. You have to always see next thing after unanimously agree, after it is decided that there's a joint control. Next thing is joint operation or joint venture. If it's a joint operation, no separate entity. If it's a joint venture, there's a separate entity. Learn it like this. So the mind does not appear to be a separate entity and would therefore most likely be classified as joint operation. I told you it's not a separate entity, joint operation. If it was a separate entity, use joint venture and deal under IAS 28 equity method. Okay. Again, we'll go to see whether it has a, because they didn't say that they have a separate entity or anything like that in the case study. So that's how I know that there's no separate entity. Otherwise, they will mention it if there's a separate entity. If they don't mention, it's always assumed they don't have a separate entity, hence joint operation. Next, business combination, the last requirement. Okay. Before I finish business combination, a marking scheme is just below, so it's better we can go through. Okay. You see, 4 marks. I told 4 and 3. First, you discuss the two measurement bases and then net realizable value and the relevant standards. For example, we use so many standards for that. IS 37. Then we mentioned what was that? I don't remember actually. I forgot part A. Okay. Yes, it was IFRS 9. Yes. So whatever standard is there for that 4 marks, and application of IS to scenario is just 3 marks. Okay, 4 3. Next, this is 4 4. You see, discussion of IS 16 and IS 36. The asset and the impairment. Whenever impairment is there, you have to talk about first the asset. What type of asset it is? Is it an intangible asset under IS 38? Is it a tangible asset under IS 16? Is it a financial instrument under IFRS 9? Which type of asset? Then only you talk about impairment. Okay, so 4 marks is equal. And part C, when we are coming to part C, it's for 10 marks. Okay, 4 marks for discussion of control in the conceptual framework and other relevant standards, that is IFRS 10. So I would say 2 marks for conceptual framework, 2 marks for IFRS 10. Next, and also the joint control, right? Joint control also. So everything 4 marks. Next, a discussion of business combination for IFRS 3, that is 2 marks. And the last 4 marks, it's not here, but let me tell you, because you will be getting 10 marks for part C. So the last 4 marks is for applying it to the scenario. Okay, business combination. IFRS, this is a very common standard which is asked. So this is also you have to something that you have to learn, business combination, which we heavily use because it's a group accounting standard. It's heavily used. A business combination is defined in IFRS 3. Okay, business combination is defined under which standard? IFRS 3. It is defined as a transaction or other event in which an acquirer obtains control of one or more businesses. So the important word is control of one or more businesses. Controls over what? One or more business. Business combination, you see? So control of business only. For example, when you're acquiring 60% of an entity, that means you are acquiring a subsidiary. So that subsidiary, you are having a control over that entity. So all the way we calculate our NCI, goodwill, everything is until under what? IFRS 3 only. Okay. So a business is defined, and because we are having control over business, the next line is what is business now? Define it. Definition is also given in under IFRS 3. A business is defined as an integrated. This also you can memorize because there's the same definition you have to use if you have to describe a business according to IFRS 3. It is defined as an integrated set of activities. That means all the activities are integrated. It's not isolatingly you are doing. Everything is related to everything. It's integrated, okay? And assets capable of being managed to provide outputs. The mind does not represent. So the mind, is it a business? It does represent a business. Because there are so many things which has to be done, which are integrated in the mind. So it's a business. Okay. However, the Phil's purchase of how much he has purchased, only 40%. And 40% we know that it's not a control. To have a control, you have to have more than 50%. So however, but you can say they have an influence. That means it's an associate, you can say. The Phil purchased 40% interest and is not a business combination. Not a business combination because Phil does not have a control. Simple. Not more than 50%, they don't have control. If they don't have control, it's not known as a business combination. So then what's next? That said, IFRS 3 states that the accounting treatment of the acquisition of an interest in a joint operation. But what does IFRS 3 says on the accounting treatment if it is an interest in joint operation? Because in the above, it's a joint operation only, right? You have acquired in a joint operation, if not a subsidiary. If not, if not having control, but you have a joint control. Acquisition of an interest. What does IFRS 3 says about it? That you have to write. Okay. So acquisition of an interest in a joint operation that meets the definition of a business should apply the same principles as are applied to the business combination. You see, even if it's a joint operation, if it meets the definition of business, same principle you have to apply that you would have applied if it was a business combination. If it would have a control, that means business combination only, unless those principles contradict IFRS 11. That means if some principles under business company under IFRS 3 are contradicting, going against IFRS 11, then you cannot use it. Then preference has to be given to IFRS 11 first. Okay. In other words, identifiable net assets of the journal should be measured at fair value. These things you have to write because according to IFRS 3, okay, if it is proven that it's a business, you have to calculate this following things: net asset, goodwill, NCI. Of what? Joint operation, because this is a joint operation. So identifiable net assets of the joint operation should be measured at what? Fair value. Fair value. That's what we do in assets, right? When it's a subsidiary, what do we do? Identify the net asset of the subsidiary at fair value. So this is not a subsidiary, but it's a joint operation. So same thing we are doing here. Identify net assets of the joint operation at fair value. However, unlike with a business combination, Phil should not recognize any NCI. Should not recognize any NCI. Why? Normally, what do we do when it's a subsidiary? We recognize NCI. But here, it's a joint operation. Because it's a joint operation, how can you recognize NCI? NCI we recognize when we are having a subsidiary. Let's say we bought 60%. So NCI is 40%. Here it's a joint operation. So we will not have any NCI. will not have an NCI for associate, will not have an NCI for joint operation. Only for a subsidiary will have, which is more than 50% if we have acquired. Okay. Instead, Phil should only recognize, and no goodwill also. Goodwill will recognize, but NCI will not be there in that calculation. Instead, Phil should only recognize its share of mind assets. What should they recognize? Phil, you should mention the name of the company. Should recognize its share of mind assets and liability. Whatever the Phil, that means 40%. 40% of the asset, 40% of the mind's liability, you have to recognize for Phil. Not 75%, not with that 35%. See, that 40 plus that 35% we are taking to decide, to show that they have a joint control. But when we are recognizing assets and liability, that means to recognize net assets. Because net asset is what? Assets minus liabilities. Okay, for Phil, we are only taking the Phil's share. Okay, that is 40%. Next, goodwill, yes, we have to recognize, but the formula changes, no NCI. So it is simply goodwill is the should be recognized for the difference. It is the difference between the consideration that you have paid to buy that joint operation. Okay, for that interest in the joint operation, and simply Phil's share of net assets acquired. That means they are assets minus liabilities of the Phil. So you consideration paid minus the net asset of the Phil. You just take the difference between two. That is known as goodwill that you recognize. Okay, but in normal business combination, when you buy a subsidiary, you add NCI also, right? NCI plus consideration minus net asset of the subsidiary. Here the only difference is not NCI, it's not taken. It is simply consideration minus net asset, that's it. So that's the only difference. And hope that now you will find these things easy, right? And question 25 is not at all tough. Question 25, in fact, I feel that section B is easier than section A. First of all, the case studies are smaller, so you can, and you know that there are specific standards, more than 2-3 standards, and it's very easy also, the case studies. So that's it for question number 31. See you in the next question. Till then, take care.